Mr.
Good
Jami
evening.
Ahmed.
Good evening,
Our
Mr.
class governor. Good
Shiwaju.
evening, sir.
Good evening. Asuwaju, good evening, sir.
Ross, we are doing great.
Thank you very much, sir.
Can we check our speakers? Let's check our speakers to ensure that the speaker is kept under control. Particularly, try to mute your speaker. What we are trying to achieve is an effective class where we have less distractions, less external interference. All right. Once again, good evening all. Of course, we shall continue from where we stopped last week. Last week, we discussed financial statements analysis. All right, our class is usually 8:45 to 11 p.m. I've observed that at times we want to start by 8:30, but we have spent 2 months running the class. So changing the time now might create a bit of distortion. So we are going to be running class for 2 hours, 15 minutes. By God's mercy. All right. Last week, we discussed financial statement analysis. We explained that financial analysis is the evaluation of the company's past financial performance and its prospect for the future, and the evaluation of the future financial prospects. This evaluation involves financial evaluation involves the evaluation of the financial statements and the evaluation of the statements of cash flows. Now the question is, why are we evaluating the financial statements? Why are we evaluating cash flow statements? We are evaluating the financial statements so as to determine the financial position of a company. The financial position of a company relative to other companies. Your financial position will have impact on your image. Your financial position will determine your credit rating. Your financial position will determine your price-earning ratio. Company's financial position has impact on many variables. We carry out financial statement analysis so as to determine the company's financial position relative to other companies. We also carry out evaluation of the income statements. We also carry out the evaluation of the income statement so as to determine the company's past financial performance. Then lastly, we evaluate cash flow statements so as to determine the impact of the sources of cash flow and the uses of cash flows on the company's operations and financial conditions. I'll take that again. We carry out evaluation of the statement of cash flows so as to determine the impact of the sources and uses of cash flow on the company's operations and on the company's financial conditions. Now, how do we carry out this evaluation? We discussed this last week. We have horizontal analysis, vertical analysis, and ratio analysis. Under the ratio analysis, we have profitability ratio, liquidity ratio, solvency ratio, and investors ratio. This was discussed last week. Tonight, we are going to demonstrate how to carry out evaluation of the financial statements. We shall demonstrate this tonight by looking at page 164, question number 1. Please refer to your study pack. Page 164, question number 1. Osanko Limited. Okay, please, can you mute? All right. Please, let's refer to that question. Page 164, illustration 1. Are we good to go, please? Are we good to go?
Yes, Ashwaju, you are good to go, sir.
Yes, sir.
Yeah.
Yes, sir.
Victor, thank you, sirs. I'll read.
Page what again, please?
Page what?
164. Page
Good
160.
evening, sir. Please, could you please confirm the page on the material again, sir?
The page is 164. Question 1. It's even on your screen. It's on your screen. Question 1, page 164. All right. Osanko Limited, manufacturer of wire and cables, was bought from its conglomerate parent company in a management buyout deal in August 2010. 6 years after, the managers are considering the possibility of listing the company shares in the Nigerian stock market. Look at us, paragraph 1. Osanko Limited. That means Osanko is a private limited company, manufacturer of wire and cables, was bought from its conglomerate parent company in a management buyout deal. In August 2020, 6 years after, the managers are considering the possibility of listing the company shares on the Nigerian Stock Exchange. We are considering converting private limited company to public limited company.
Bring and come now with a new.
Mary, please can you mute? Whatever you discuss in your private home, please keep it private. The following information is made available. Osanko Limited income statement for the year ended June 30, 2016. You have the turnover, cost of sales, profit before interest and tax. You have your interest, profit before tax. You have your tax. You have the profits attributable to shareholders. That is the profit after tax. You have the dividends and retained profits. Statement of financial position. Non-current assets. You have your current assets, ordinary share, ₦1 each. You have your reserves. You have account payables after more than 1 year. Debentures. You have your trade payables and bank overdraft. Average performance ratios from the industry sector in which Osanko Limited operates as follows. The industry sector average are given below. You have the return before interest and tax on long-term capital employed, return after tax on equity, operating profits as percentage of sales, current ratio, asset test ratio, total debt to equity, dividend cover, and interest cover ratio. You are required to evaluate the financial state and performance of Osanko Limited by comparing it with that of its industry sector. This question is very direct. Compare the performance of Osanko with the industry standard. Evaluate the performance and financial state of Osanko by comparing these with the industry standard. This question is very direct. You have been given the ratio, the average industry standard. Compare this with Osanko's ratios. All right. Let us go to our calculation. Look at the comments. The financial performance and financial health of Osanko Limited in relation to that of the industry sector as a whole can be evaluated by comparing its financial ratios with the industry averages. Page 164. Question 1. All right. Return before interest and tax on long-term debt. The average for the industry. Let's pick my pen. The average for the industry is, look at it please, 24% return before interest and tax on long-term capital employed. For the industry average is 24%. Pick this. This is 24%. Now let's compute for Sanko. Return before interest and tax. Please note, this is the profit before interest and tax. Let us go to the income statement for Sanko. Look at it. Profit before interest and tax, 12.25 million. We pick this. Let's go to workings. Look at it, please. Profit before 12.25 million over long-term capital employed. Long-term capital employed. Your long-term capital is ordinary share capital plus reserves plus long-term debt. Long-term debt is your debentures. Let's go to the question. Please look at it. Ordinary share capital amount 6.7 million, 6.75 million. Reserves 24.25. That means shareholders' funds 31. 6.75 plus 24.25. Now look at this, debentures. Debentures is a long-term debt, 5.5. We are going to add these three together. 6.75, 24.25, look at it, 6.75 plus 24.25 plus 5.5. Please sum up. That is the long-term capital employed. Long-term capital. Please sum up.
36.5.
36.50. Therefore, I can come here 36.50 multiplied by 100. That will give you return before interest and tax on long-term capital employed. Please compute. What do you have?
33.56.
33.6.
Okay, 6.
Approximately. Or you can take it to 34.
Oh, you're. What's going on?
Mr. Moses, please, can you mute? Okay, you can leave it, Sha. Provided you can control your speaker at home. We have 33.60. Next, return after tax on equity. Your return after tax is your profit after tax. Your equity is equity funds, shareholders' funds. Let us go to this statement. Profit after tax. Profit attributable to ordinary shareholder. 7.75. We pick this. That is the return after tax. Equity. Your equity is ordinary shares plus reserve. This is the equity funds. Equity funds. 31 million. We can return down, working to profit after tax over equity, 7.75 divided by 31, multiplied by 100. Please compute the ratio.
25.
25%.
25%. We return the average for the industry. 16%. Pick that. 16%. You have resolved that. You now come here. Operating profit as a percentage of sales. Your operating profit is the profit before interest and tax. Look at it. Operating profit, 12.25. Our sales, your sales is your turnover, 91.25. Please divide 12.25. Look at it. 12.25 divided by 91.25. What is operating profit as a percentage of sales?
That's 13.42.
13.42%. Now check the industry average. We have 13.42. The industry average is 11%. Next, current ratio. For the industry, 1.6, ratio 1.6 to 1. Ratio 1.6 to 1. What this means is that your current asset should be able to finance your current liability in 1.6 times. Your current asset should be able to finance your current liability 1.6 times. Now let's go and compute for Sanko. Our current assets please look at it. Inventory plus receivables plus cash at bank, 25.25. Our current liabilities, trade payables plus bank overdraft, 22.5. So I'm going to divide 25.25 by 22.5. Look at it here. 25. $25.25 divided by 22.5. What do you have? 1.12.
1.2.
1.10, ratio 1.10 to 1. That means that this company, the asset can only finance the liability. Current assets can only finance current liability by 1.01 times. This is below industry standard.
So I have a question, sir.
Please go ahead.
But from what we computed now, the result we got is 1.12. How is it that we are now having 1.01? I just want to.
Okay, why don't you ask this question? Examiner gave you 1.6, ratio 1.6 to 1.
No, I just
What
want. I
means
just
is that
so I just wanted to know.
you're asking why am I adding 1 to it?
No. I just want to know why you added
question.
0. No, why you added
And
0?
the same thing, I'm 0. Is it 1.1?
It's 1.12.
Oh, 1.12. Oh, sorry.
Yes, sir.
Great game my grandpa made up.
Oh, sorry.
The greatest treasure is having fun. Love Grandpa. George felt proud.
1.12. That means an error here. All right. But the question.
Why are we adding 1 to it?
Please, let me repeat myself. If you have any question to ask, please indicate by raising up your hand. Do you understand?
I'm so sorry, sir.
Because immediately I'm trying to explain, you just cut into that explanation. First is the examiner gave you a ratio. He said current ratio is 1.6, ratio 1.6 to 1. What that means is that your assets, current asset is 1.6. Current liability is 1. The ratio of current assets to current liability. Current asset is 1.6, while current liability is 1. If you now compute your own, you have gotten the ratio to be 1.12. That 1.12 represents current asset. That 1 represents current liability. That means current asset is 1.12 times bigger than current liability. The industry average is 1.6, ratio 1.6 to 1. Why you computed ratio 1.12 to 1? That means that ratio is below the industry standard. That is ratio. If I say ratio 2 to 1,
I'm going to write any pictures.
I hope it's better, please.
Thank you, sir. I'm so sorry for not raising my hand.
Please, can you speak up? I hope it's better.
Yes, sir. Thank you, sir. I said I'm sorry for not raising my hand at the first place.
No, it's okay.
Thank you,
Because
sir.
at times I wanted to say something. Somebody just cut in along the line.
Giorgio, you got to get an adult to help you standing up.
Madam Mary, please, can you mute? All right, let's continue. Now look at next ratio. Quick ratio. Asset set ratio. Examiner say ratio 1.0 to 1. What that means is that your current assets is 1.0. Your current liability is 1. Now to compute our asset test ratio, we are going to exclude inventories. We are going to pick account receivables and cash at bank. 11.75 plus 2.5. Look at it, please. Current liability excluding inventories. My account receivables, 11.75 plus cash at bank, 2.5 divided by current liability, 22.5. Please work this out. 11.75.
Is it in percentage?
11.75 plus 2.5. What do we have?
14.25.
Oh, 14.25. 14.25 divided by 22.5. What do you have, please?
Are we multiplying by 100?
Yeah.
If not, 0.6333.
0.6333.
Are we doing what?
Are we doing percentage?
Yeah.
Okay, you don't compute current ratio or acid test ratio in percentage. We don't multiply by 100. It's in ratio. 0.63 ratio 0.63 to 1. That means our current asset less inventory is 0.63. Our current liability is 1. Liability is more than current assets, liquid current assets. Our liquid current assets is not sufficient to finance our current liability. So please, you don't multiply liquidity ratio by 100. Your current ratio, your acid test ratio is computed in ratio, not percentage. So if I want to write this now, for Sanko, I have 0.63 to 1. Why the industry standard is 0.1 to 1. 0.63. Ratio 0.63 to 1 is less than ratio 1 to 1. That means Osanko Limited does not have sufficient cash flows, does not have sufficient liquid cash flow to finance its current liability. Based on the industry standard. Is that clear, please? Yes, Oluwakemi.
Well done, sir. Thank you, sir. Sorry, in our material under quick ratio, is the same thing as added test ratio. We are having cash plus marketable security and account receivable. What do we mean by marketable security? Sorry, sir.
All right. No, it's fine. And that shows that you are looking at the material. Marketable securities. These are securities that are tradable, that can be sold within a short time and convert to cash. For example, your treasury bill. If you invest in treasury bill, you can buy treasury bill today and sell it tomorrow to collect your cash. Your treasury bill is a marketable security. These are securities that can be converted to cash easily or within a short time. Like what we call it deposit certificates. You can trade the certificates for money. They are marketable securities. These are securities that you can easily convert to cash. They are tradables. Even your shares. You can go to the stock market. I want to sell these shares. That means you can convert it to cash. At times you invest money on securities. They are instruments that can be sold within a short time and convert it to cash. Is that better, please?
Yes, sir. But is it the same security? I mean, is it the same thing as those one we have under our equity capital?
Under
I mean,
what?
why equity capital, or why is it part of our current assets? That's my concern, sir.
No, its concern is answered. Security that can be converted to cash at a short time. What do we call current assets? What is current asset? Those assets that you can convert to cash within a year. Your trade receivables. Why is it classified as current assets? Assets that can be converted to cash within a short period.
Thank
Your
you, sir.
inventory. Why do we call it current assets? Assets that we can convert to cash within a short period. Is that better, please?
Yes, sir. Thank you, sir.
All right. Number next, total debt to equity. That is your gearing ratio. Your total debt over equity. Let us look at the industry average. 24%. The industry average is 24%. Now let us compute for Osanko. Our total debt. Debenture is a debt. 5.5 million. Bank overdraft is a debt. 5 million. Our total debt is long-term debt plus short-term debt.
Long-term debt and short-term.
Total debt. Your total debt is equal to debentures plus bank overdraft. Our debenture is 5.5 million. Bank overdraft is 5 million. Total debt is 10.5 million. Your equity is share capital plus reserve. We have done that before. Look at it. Equity funds, shareholders fund, ordinary share capital plus reserve, 31 million. Pick that. Therefore, debt to equity ratio, debt over equity multiplied by 100. Our total debt 10.5, equity funds 31 multiplied by 100. Please, what is the percentage?
34%.
33.
34%.
33, 34.
Approximated.
Yeah, approximately.
All right,
Yeah,
34%. That's fine. Okay. Please note, trade payables is not a debt. So trade payable is not debt. It's not a borrowing.
Yeah, that's what you want to pay
Please,
to
your trade payables is not, you didn't borrow money. You bought goods on credits. You are going to pay later. Supplier supply you goods on credits. You are going to pay later. That is different from borrowing. So please don't make that mistake. Your trade payables is not part of your debt.
No matter.
It's a liability, but not borrowing. I can come here. This is 34%. Our dividend cover. How do we calculate dividend cover ratio? What is the formula for calculating dividend cover ratio?
Any per share divided by dividend per share.
Correct. Please don't multiply by 100. Earnings per share divided by dividend per share. If you are not giving earnings per share and you are not giving dividend per share, you can also calculate as total profit after tax divided by total dividend. Please just allow me to take more of water. If you are not giving earnings per share and you are not giving dividend per share, you can also calculate your dividend cover ratio as total profit after tax divided by total dividends. I can come here. Total profit after tax, 7.75 million. Total dividends, 0.75. Please divide. 7.75 divided by 0.75. Look at it here, please. 7.75 divided by 0.75. 10.3 times. The number of times the company's attributable profits covers dividend payments. Number of times the company's attributable profits covers dividend payment. We have 10.3 times. 10.3 times. What is the average for the industry? 4 times. Interest cover ratio. Your interest cover ratio is calculated as
Profit before tax, profit before interest and tax over interest expenses.
I agree. The profit before interest and tax divided by the interest expense. The profit before interest and tax, look at it. Profit before interest and tax divided by the interest expense. Our profit before interest and tax, 12.25 million. What is the interest expense?
3.25. Yes, yes.
3.25. Please don't multiply by 100.
So the answer is 3.85.
3.25. The answer is
3.85.
3.85 times.
Sorry, it's
It's
0.77.
3.77.
Sorry, sir. 3.77.
Okay. There's an error with that computation.
Yeah, that's correct. 3.77.
3.77 times. $3.77 times. The industry standard, 4.5 times. We have computed the ratio. We now need to do our notes. Before we go to the notes, please look at this place. If you check from year to year, all these are profitability ratio. The first three ratio, these are profitability ratio. Now look at these two places. Here we have liquidity ratio. And look at this place. These two. Leverage ratio. I've only put this to guide our explanation. Please look at it. Average for the industry. Return before interest and tax on long-term debt. The average for the industry is 24. While Osanko is achieving 33.6%. That means Osanko is making enough profits to return to the providers of long-term capital. The shareholders and the ventures holder will be happy. Osanko is making enough profits to be able to return profits, higher profits, to the providers of long-term capital. Also look at return after tax on equity. Industry average is 16%, while Osanko is achieving 25%. Osanko is able to make enough profit after tax for the shareholders. Osanko is achieving 25% return profit after tax to shareholders. The shareholders will be happy. This is far above the industry average. Also look at it. Operating profits as a percentage of sales. The average standard for the industry is 11%, while Osanko is achieving operating profit as a percentage of sales, 13.4. In terms of profitability, Osanko is doing well compared to the industry standard. Osanko is achieving more profits. Now look at liquidity. Look at the current ratio. The industry average is 1.6 times. Your current assets should be 1.6 times bigger than your current liability. But Osanko is achieving 1.12. Also look at asset test ratio. The industry average is ratio 1:1. While Osanko is achieving ratio 0.6:1. This implies that in terms of liquidity, Osanko is not liquid. Although Osanko is achieving bigger profits, but this profit is not represented in cash. This profit is not represented or is not reflected in cash. That's a serious concern. We can see that you are making big profit. Cash. Business require cash on a daily basis. Businesses require cash on a daily basis. Now look at the last three ratios, particularly total debt to equity. The industry average is 24%. Why Osanko is having 34% total debt as a percentage of equity? What this implies is that Osanko is highly geared. It also means that Osanko financial risk is very high. Your gearing ratio measures your financial risk. Recall, when we did, what's that topic? Capital structure. Yes. Your gearing ratio defines your financial risk. The extent to which the company has borrowed money to finance its business. Osanko is exposed to higher financial risk. Coupled with the fact that the company does not have sufficient cash flow as reflected in current ratio and asset test ratio. You are going to require cash to pay interest. Your financial risk is high. Your cash flow is low. Now look at interest cover ratio. It's also used to measure financial risk. The interest cover ratio can be used to measure companies' solvency ratio or solvency risk. The standard for industry is 4.5 times, while Osanko is achieving 3.77 times. What it means is that there are two things. You can interpret this in two ways. Osanko does not have sufficient profits to meet interest payments compared to the industry standard. Osanko does not have sufficient profits to meet interest payments. The second interpretation is Osanko level of interest expense is high because the company has borrowed more money. Total debt is high. Your interest expense will be high. And that will affect your interest cover ratio. Then lastly, dividend cover. number of times your profits can cover dividend payments. If you look at this ratio, this company is better. Osanko is not paying dividend much. 10 times. You have enough profits 10 times to meet dividend payments. It also means that the company is retaining more of its profits and paying less dividends. All right. We are trying to explain this. We can go to the comments. We can go to the comments and read. Look at the comments. These ratios, the ratios we have computed, can be used to evaluate performance in terms of profitability, liquidity, and financial stability. All the ratios we have computed can be used to measure the performance of Osanko Limited in terms of profitability, liquidity, and financial stability. 1. Profitability. Osanko Limited return on capital employed, return on equity, and operating profit margin are all significantly above the industry averages. These ratios are significantly above the industry average. Although the first two ratios could be inflated due to assets being shown at their book value, the profit margin indicates that Osanko is managing to make good profits, which could be due to the successful marketing. Osanko is achieving good profits. This may be due to marketing efforts, low cost base, or its occupation of a particularly profitable niche in the market. Next, liquidity. Both the current ratio and asset test ratio are well below the industry average. This suggests that Osanko Limited is either short of liquid resources or is managing its working capital poorly. Financial stability ratio. The gearing ratio is high compared to the industry. And 48% of the debt is in the form of overdraft. If you go and look at the total debt is 10.5 million. Out of this 10.5 million, 5 million is overdraft. That means 48% of the debt is in overdraft. It's in the form of overdraft. Overdraft is repayable on demand. Overdraft facility is repayable on demand. That means overdraft is a risky source of finance. Therefore, overdraft is a risky form of debt to use in large amounts. The debentures is repayable in 2 years' time. If you look at the question, we are giving financial statements for 2016. Now check the debentures. A date is attached to that debentures, 2018. That means the debenture is repayable in 2018. And we are going to require cash to repay this. Osanko Limited cannot redeem this out of its cash flow. Just 1 minute. All right, let's go on. So, in summary, look at the summary. In summary, profit performance is good, but there are significant weaknesses in both the liquidity and financial stability. This problem needs to be addressed. The profit performance is good, but the liquidity ratio and financial stability ratio are cause for concern. You are done with your explanation. Computation of the ratio may not be a problem. In fact, it shouldn't be a problem. But you must be able to interpret the ratio and make appropriate recommendation. Calculating the ratio will most likely not be a problem. But you must be able to interpret the ratio you have computed and make your recommendation. All right, any question, please? Any question, any comments? Yes, Temitope.
Yes, sir. Please, I noticed that unlike the industry average, we are not consistent with the decimal place we use. Sometimes we round up, sometimes we use 1 decimal place, but sometimes 2. So is that not a concern? Is it? I'm just wondering that, can we just keep using any decimal place we want, or do we round up?
All right, thank you for that observation. We cannot just be using any ratio we like. We are supposed to be consistent. It is not right to be using any ratio. If you want to stick to the nearest whole number, that is better for us. We are supposed to follow the industry, 24%. So we should have 34% here. We should have 13% here. This is fine. Okay, 1.16. In fact, if you want to take this to 1 decimal places, we can still allow this to fly. It's not a problem because this is in ratio, not percentage. We can allow this to fly. So you cannot just be taking anything you like. You have to maintain consistency. Percent. This is fine. This is still fine. 4.0. 10.3. 1 decimal place. We can take this to no, I picked the wrong thing. All right. It is good to maintain consistency. All right, thank you for that observation. All right, there's no comment, no question again. The B part of the question. Just 1 minute. The B part of the question, so that we can round up this question. Examiner says we have gone too far. Discuss 4 probable reasons why the management of Osanko Limited is considering stock exchange listing. I'll take that again. Discuss 4 probable reasons why the management of Osanko Limited is considering stock exchange listing. Why would a private company, a private limited company, be considering converting to public limited company? Is because of the benefits of public companies. What are these benefits? You have access to large pool of finance. What are these benefits? Look at it, please. Osanko, a company such as Osanko, may seek a stock exchange listing for the following reasons. 1, to allow access to a wider pool of finance. If you have a public company, you can access wider sources of finance. companies that are growing fast may need to raise large sum than is privately possible. By converting your company to public company, you can obtain a larger source of financing. Number two, it improves or to improve marketability of your shares. Once a company is listed, you can trade your shares. You can sell your shares to the general public. One advantage of listing is that it improves the marketability of the shares. Number three, it allows capital to be transferred to other ventures. By converting a private company to public company, the founders, that is the owners, may wish to liquidate the major part of their holdings, either for personal reasons or for investments in other businesses. You can run a private business. Later you want to convert to public. That means you want to sell part of your interest to the public. You are going to generate money. You can use this money to invest in other businesses. To improve company's image. A publicly quoted companies are well rated than unquoted companies. Quoted companies are commonly believed to be more financially stable. And this may improve their image with their customers and suppliers. Examiners say mention 4 possible reasons why Osanko Limited may consider stock exchange listing. Please watch out for something like this in your exam. Please watch out for questions like this in your exam. We are done with our question. Any question, please? Wow. Any question, please? If there's no question, please refer to question number 2. Question number 2 on your study pack, page 164/165. Page 164/165. We have 50 minutes. It is doable. Meanwhile, the ICAN study pack is out. Please, more seriously, look, that study pack should be your first textbook. That study pack should be your #1 textbook. All right. Any volunteer? Okay, let me read. We have limited time. Question 2. The following financial information is available for Warri PSC. You are giving information for 2014 to 2017. You have the equity earnings, number of ordinary shares, price per share in cover, and dividend per share. Assume that the share prices are as at the last day of each year. Requirements A for 14 marks. Calculate Warri PSC's earnings per shares, dividend yield, dividend cover, and price earning ratio. Explain the meaning of each of these terms and state the limitations they may have. 14 marks. The first question we treated was ICAN tested question for professional students. This question we are about to treat is also ICAN tested student question for professional students. So you are required to calculate earnings per share, dividend yield, dividends cover, and price earning ratio. Then you are going to explain the meaning of each of these terms and their limitations. Let us go to it. The question is very direct. Calculate earnings per share. Look at the solution board. Suggested solution. What is earnings per share? How do we calculate earnings per share? Look at the formula, please. Earnings per share, equity earnings divided by number of ordinary shares multiplied by 100. We are going to calculate for 2040, 2050, 2060, and 2070. You can do it straight. Look at it, please. 200 million divided by 2,000 million multiplied by 100. $200 million over 2,000 million multiplied by 100. Please, what is the earnings per share? Please, what is the earnings per share? 10 what?
10. 10%.
10%.
Okay. Earnings per share is not calculated in percentage. You either calculate in naira or kobo. By multiplying by 100, that will give me the answer in kobo.
Is 0.1.
Okay. 10 points.
0.1.
2.1.
That should be 10 kobo, right?
So that should be 1 kobo.
The answer is 10 kobo. Your earnings per share can be calculated in naira or kobo. If you want to calculate in naira, then don't multiply by 100. That will give you 0.1 naira. But if you want to calculate in kobo, multiply by 100. Now, why do I choose kobo? You are giving the price per share in kobo. You are giving dividend per share in kobo. So I'm going to maintain the earnings per share in kobo. If you go to year 2015, equity earnings. Your equity earnings, let's create space. All right, let me take that. For 2015, equity earnings is 225. Number of ordinary share, 2,100. Please multiply by 100. What do we have?
Is 0.11.
10.7 kobo. Is that correct, please?
Yes.
Yes, sir.
Yes.
10.7.
Go to year 2016. 205 divided by 2,100. Multiply by 100.
9.76 kobo.
9.76. Go to year 2017. 230 divided by 1,900. Multiply by 100.
12.1.
12 points.
1.
12.1 kobo. You have gotten the earnings per share. You have gotten the earnings per share. Next, dividend yield. Next, dividend yield. What is dividend yield? How do we compute dividend yield? How do we calculate dividend yield? Your dividend yield, dividend per share, divided by market price per share. Multiply by 100. Your dividend yield, dividend per share over price per share, multiply by 100. Now let's go back. Please look at, you have compute dividend per share. Or is even here? Dividend per share, 5 kobo. Price per share, 220. Please, 5 divided by 220, multiplied by 100. What do you have, please?
2.27 kobo.
We can take to 1 decimal places. 2.3. Go to 2015. Dividend per share, 7 divided by 305, multiplied by 100.
2.3.
Go to the next year, 2016. Dividend per share, 8 kobo. Price per share, 290. 8 divided by 290, multiplied by 100.
2.8.
2 point what, please?
2.8.
2.8. Go to 2017. Dividend per share divided by price per share, 9 divided by 260.
3.5.
3.5.
3.5. Your dividend per share is actual return on shareholders' investment. That is the return to shareholder. Dividend cover. What is the formula for dividend cover? Earnings per share divided by dividend per share. Formula for dividend cover. Pick your earnings per share. Divide it by dividend per share. You have computed earnings per share. 10. Dividend per share 5. 10 divided by 5. This is 2 times. 2. Next. 2015. Dividend per share 10.7. Sorry, earnings per share 10.7. Dividend per share 7. 10.7 divided by 7. What do you have?
1.5.
1.5.
5.
Next. 2016. Earnings per share 9.7. Dividend per share 8. 9.7 divided by 8. 1.2.
1.2.
Next. 2017. Earnings per share 12.1. Divided by dividend per share 9. 12.1 divided by 9.
1.3.
1.3. You have computed dividend cover ratio. Then price earning ratio. Your price earning ratio. Price per share divided by earnings per share. Your price earning ratio. The price per share divided by earnings per share. Our price per share for 2014, 220 kobo. Why our earnings per share 10 kobo. 220 kobo divided by 10 kobo. That will give you 22 times. This calculated in times. In times. This in percentage. Next. Price per share 305 divided by earnings per share 10.7. Please, 305 divided by 10.7. What do we have?
28.5.
Next. $290 price per share divided by earnings per share 9.7. 290 divided by 9.7.
29.9.
Next. Price per share divided by earnings per share 260 divided by 12.1.
21.5.
You have calculated the ratio. The 4 ratios we are required to calculate. We have calculated it. Now, examiner now says, what is the meaning and limitation of each of these ratios? What is earnings per share? What is the limitation of earnings per share? If you are done, you go to dividend yield. Let's look at the comments. The meaning and limitation of the suggested ratios. Earnings per share shows the amount of profit after tax attributable to each ordinary share. Earnings per share shows the amount of profit after tax attributable to each ordinary share. Although a high earnings per share, ratio generally indicates success. If the earnings per share is high, it's an indication that the company has performed well. But care must be taken in interpreting the trend in earnings per share. Because when there have been share issues, where the company issue more shares, that will impact on earnings per share. Also, where a convertible debts are issued, that can also have impact on earnings per share. Earnings per share is computed using accounting profits. Accounting profits are subject to distortion and manipulation that can affect our earnings per share. That is the limitation of earnings per share. Number next, dividend yield. Dividend yield shows the ordinary dividends as a rate of return on share value. That is the actual return on shareholders' investment. The figure is of limited use because it shows only one part of return to equity shareholders. It only considers one aspect of return. Return to investor shareholder is two: dividends and capital growth. Number three, dividend cover ratio. Dividend cover ratio shows how many times earnings is bigger than dividends. Earnings per share is greater than dividends. A high dividend cover ratio shows that a large proportion of equity earnings is retained and being reinvestment for growth. If you compute your dividend cover ratio and you observe that the ratio is rising, it's an indication that the company is paying less dividends. The company is reinvesting its money for future growth. Then lastly, price earning ratio. Oh, I've gone too far. The price earning ratio shows how many times the share price is bigger than earnings. The price earning ratio is one of the most important measure of company's performance. The price earning ratio is one of the most important financial performance measure. It relates the market price of equity or the market price of shares to the earnings generated from the shares. The price earning ratio relates the market value of a share to the earnings generated from the shares. A high price earning ratio, indicate that the company is likely to achieve higher earnings at future periods. While a low price earning ratio is an indication that the company will not generate sufficient earnings at future periods. What is the limitation of this ratio? The limitation is that it uses market price. In reality, several factors will affect market price, which are not within the control of the company. All right, that's a limitation. You are using market price to earnings per share. There are several factors that affect market price of a product or market price of a share. Oh, all right. We are done with requirements A. Look at the B part. Examiner says, explain why the changes that occurred in the figures calculated in A above over the past 4 years might have happened. Examiner says, explain why the changes that occurred in the figures calculated in A above over the past 4 years might have occurred. Look at earnings per share. In 2014, earnings per share was 10 kobo. In 2015, earnings per share 10.7 kobo. In 2016, earnings per share 9.7 kobo. And in 2017, earnings per share is 12.1 kobo. Examiner says, explain why these changes has occurred. To do this, you are going to compare 2014 and 2015, 2016 and 2017, 2015 and 2016, and 2017 and 2016. Let's go to that explanation. Trend in 2015. The trend in 2015, that is 2015 compared to 2014. Look at the share capital. Let me go to the question. Please look at 2014 and 2015. Number of shares. In 2014, 2,000 million shares. In 2015, 2,100. Compute the percentage increase. What is the percentage increase?
5%.
5%. Also check. If you want to explain this, we have computed earnings per share. And the variable used is equity earnings and number of ordinary shares. If you compare equity earnings, 2014, 200 million. 2015, 225 million. What is the percentage increase in equity earnings? You are going to do 225 minus 200 divided by 200. What's the percentage?
Size 0.125.
One what?
0.125.
0.125.
No, that can be percentage. Now multiply by 100, Joe.
12.5%.
Now that's how to calculate percentage now. When you divide, you now multiply by 100. That means the equity earnings increased by 12.5%. While number of share increased by 5%. This will have impact on your earnings per share. Look at the comments here. In 2015, share capital was increased by 5%, probably through rights issue. Equity earnings increased more than proportionately, resulting in 7% increase in earnings per share. Compare earnings per share in 2014 and earnings per share in 2015. You are going to discover 7% increase in earnings. Indicating a successful year. Demand for the company shares rose swiftly. The demand, because of this earnings per share, there's increase in demand for the company shares. Either because of a general stock market rise or because of high expectation for Warri PLC future growth. If you go and check 2014 and 2015. What is the growth in share price? What is the trend in share price? Share price in 2014, 220. Share price in 2015, 305. 305 minus 220 divided by 220 multiplied by 100. That will give you the percentage growth in share price. That should be like 40%. The growth in share price will have impact on our price earning ratio. So when we say trend, what is required of us here is to carry out horizontal analysis. Compare figure in 2014 with figure in 2015. Then compare figure in 2015 with figure in 2016. Compare figure in 2016 with figure in 2017. Is this figure increasing or decreasing? If it is increasing, what are the likely reasons? If the trend is falling, what are the likely reasons? That is the requirement B. Look at the dividend yield. 2.3, 2.3, 2.8. Dividend yields increase between 2014 and 2015. Dividend yield remain unchanged. That means actual return to shareholder remain the same. Between 2015 and 2016, actual return to shareholders increases. If you check 2016 and 2017, return also increased. But a major limitation with this return is that it ignores capital gain. It ignores capital gain. It only considers dividends when calculating return. You can go through the notes to look at the trend in 2015, 2016, and 2017. You can go through the notes. And you must be able to trend it. A trend is horizontal analysis of the financial statement.